Hello, listener, and welcome. This is the Making Money in Multifamily Real Estate Show. I'm your host, Dave Morgia, and today with me is Angelo Christian. Angelo, welcome to the show.
Hey, thank you so much, Dave, for having me on. I'm so excited.
Yeah, really looking forward to having you on. I'm sure you're going to bring a
Yeah,
lot of value today to the listener. So,
absolutely, absolutely.
of course, and a little bit more about Angelo, just for the listener. He is an investor, entrepreneur, and author. He's noted as one of the top producing loan originators in the country, CEO of Christian Financial. He has helped tens of thousands of people with his influential coaching, Real Estate University, which is a wealth management and mortgage banking. In addition, Angelo has authored such sought after books as King of Real Estate and 10 Habits of Highly Successful Loan Originators. He has been featured in Bloomberg, CNN. I could go on and on. Angelo, thank you once again for
Yeah,
coming on. So, just tell me a little bit more about who you are and what you do in the real estate business.
yeah. Well, that was a great intro. So I really, thank you so much for doing. I feel like after you're reciting all those things that I don't deserve to be given that great of a title.
Awesome
What,
accolades.
yeah. What I focus on more is serving and trying to add value and make a difference. And then I get approached by great people such as yourself. And then that's one thing I've always tried to really focus on is to become, so good that you can't be ignored, and just by serving and helping others. And that's one of the things that we do. Our mission statement with the company is to change lives, whether it's in the form of capital or leadership. So, my company, Christian Financial, I've been in the investing and banking world for over 15 years. So we're based out of Houston, Texas. We have one of the things that's really gotten us coined is our private money banking, where we do multifamily investment, commercial deals. And then we have our banking side where we do 1 to 4 family conventional type loans. And one of the things that was really special and unique about our company is that we really fund a lot of deals that, a traditional community bank is not able to do. So we've been able to help tens of thousands of people, whether they're investors, entrepreneurs, or even veterans or first-time buyers to get funding. So being able to offer, 2 different types of banking lines makes us extremely dynamic and versatile because we can cater to, the guy that owns a hotel, or the investor that owns, a 200-unit apartment complex, or the veteran that's just trying to buy their new home. So, and it really just depends. And maybe it's, a savvy entrepreneur that wants to do ground up construction on a large apartment complex in California. We have funding for all different types of loan programs. Because we have the capital to make the decision from our desk to fund the loan, we can get very creative and do some exotic things that are outside of the box. And sometimes when you're dealing with people or business owners, entrepreneurs, their life doesn't fit inside of a box, right? And so how we've really gotten famous is that commercial lender at a community bank or an investor, their loan got declined, and so they contact Angelo Christian, to get the funding. We do this nationwide, all over the country, right? And so and that's really been our claim to fame is to figure out how to fund deals, how to make deals work, as opposed to declining them. And we've been very successful at
Yeah, that's awesome. I love the bit. So good, you can't be ignored. That's a great little takeaway there. So,
that.
and then, so great summary. You pretty much summed it up, I think, in whole there. So, in essence, a lot of what you do is you're able to provide funding where institutional banks and others cannot. So
Right.
I guess where is that delta and how are you able to provide? And I guess maybe first let's just get into maybe I guess what your typical partner would be as far as
hmm
a borrower, and then maybe hopefully we
hmm
can get into those creative ones like you talked about later on.
Yeah. So the thing is that the way that we're structured, we have a fund where we raise capital. We work with family offices. We work with insurance funds. And the insurance sector has actually gotten big time in real estate lending because they're sitting on a lot of float. And then we have our own warehouse lines. So we have pools of capital, and I'm always looking to raise more capital. And I hope by us working today together that maybe we have some synergies to raise more capital because our notes offer high yield and low LTV, so there's a lot of protective equity there. So, but yeah, I mean, we work with. I mean, it could be a family office in Miami, it could be an insurance fund in New York, and so through this giant network of hundreds of billions of dollars of capital, We're figuring out how to place loans where, a Wells Fargo or Chase just has no interest because of their strict covenants or guidelines. So that's where the money is coming from. The type of customer, it could be, again, an investor, it could be a serial investor, it could be an entrepreneur. That's mainly our main customer, whether they're trying to do a string of portfolio properties, a package of 20 to 30 single families, or it could be he wants to take down several hundred apartment complexes. That's our typical type of customer, someone that's very seasoned. They understand the game. But they need to have securitized better funding. A lot of these investors are falling short, because they lack the good capital to get their deals closed. Right. So, I'll give you an example. One that we just closed, it was a actual resort in Washington. And this is a program that we offer. It's a proprietary loan program. We're one of the only funds or lenders in the country that will do 100% financing on a hard money loan on a commercial property. And this was a resort. It was a $12 million resort. And we are able to offer 100% financing. We give a first mortgage deed for 50% loan to value, and then we'll allow a seller to come in and do owner financing for another 50%. And so the investor was able to get 100% financing. It's a bridge loan. It's a 2-year bridge loan, to take down the property, and then they're going to get it stabilized. They want to do some rehab work to it, about $1 million in rehab, and then refinance. And then we can even be their takeout lender for the permanent mortgage, or they can go to a community bank at that time once the property stabilized. But that's one of the things that is extremely different with us, because most banks are going to want you to have, on a deal like that, 25, 35% down, skin in the game. And it's kind of cool that we can offer that, and help the investor to get, 100% loan to value. So that's a recent example of one.
Yeah, that's super interesting. 100% LTV. Like you said, you don't really hear anything past 80 realistically. So I guess, what are the differences there, and I guess what are the pros and cons, as far as pretty much everybody wants to, have max leverage, right? So where is it beneficial for the investor?
Yeah, that's good. That's a great question.
Where's the detriments too?
Yeah, and then you have to be, and again, so that's why we really prefer to deal with, seasoned people, so that they understand the risk. So obviously we're in first position. We're the first mortgage lien holder. So, the seller, they're in second position. So they, in order to make this deal work, like the one that we're talking about, or like we did one today. It was a $3.5 million hotel in Jacksonville, Florida. The seller has to understand, first off, that they are in second position. They are a mortgagee to the borrower. They'll create a deed of trust, collect interest with the borrower. So the vulnerability or the risk is to the seller. In the event that the investor, if they default, they would have to cure our first mortgage to repossess the property. So that's a very important thing for the seller to understand, whenever they're getting into this. So that's the seller's risk. The buyer's risk initially is that because it's a hard money loan, the interest rate is at 13%. That's what our fund requires to make this loan, because it's asset based. There's no credit, there's no income, there's no financial check. All we do is get an appraisal, but we don't, even if the property's vacant, we don't check on our rent roll or anything. So because of the amount of risk that we're taking on, we do charge a higher interest rate. So there's not really going to be a cap rate when you go to purchase this property, because it's a bridge loan. It's only for taking down the property. It's not for long-term holding. So going into it, the investor is not going to be making a lot of money initially, but they could take down a prize property, and then after they get it stabilized, then they can refinance, because our loan has no penalty, and then they can refinance, pay us off, and then convert it to long-term financing with a much lower interest rate, around 4 or 5%, and then have a great, cap rate once they get the property in position. But again, the very attractive thing is that if you can go buy a $5 million deal and you don't have to put $1 million down, that's extremely attractive to a lot of people, even if they have to wait a year to start making profits, right? So like if I offer that to you, hey, Dave, would you be interested in buying a B class deal in your state for $5 million? And you don't have to put any money down. And I said, hey, you just have to wait maybe 1 or 2 years until you refinance or get it stabilized to where you start making 10 or 15% yield. And there's no personal guarantor. It's a non-recourse loan. Would you be interested in that?
Yeah, it's definitely an interesting concept. I think what I like about this, Angelo, it's really interesting because you're kind of blending a few different concepts you see in real estate. You're kind of combining seller financing there in a way, and I guess one of the questions I had right off the bat actually with seller financing, it's not exactly that I understand, but what I guess is the rate the same for the seller note and your
Well, no,
note?
the
How does
seller's
that work?
note, so that's good. Another good question. So the seller's note is, I mean, that's obviously negotiated with the investor and the seller. I've seen them anywhere from, believe it or not, from 0% to 10%, and amortizations from 5 years to 50 years. And so it's based on like we did a hotel in Tennessee, and it was actually interesting. It was worth a $2 million hotel, and we did a first mortgage for 600,000. And the seller, all he did is very interesting, very smart guy. He created these large second mortgages with the borrower, and he had a $1.3 million second mortgage and with the borrower. And so even if the borrower defaulted, he didn't care because our first lien was so small, he would gladly pay that off to repossess the property because the property had so much equity. He was charging the client 6% interest. So you have some very savvy, sophisticated sellers that realize that, okay, I'm going to be in second position, but because the property has so much equity, because when we've closed on that loan, he got his $500,000 from us. So he had $500,000 up front. Now he's collecting a 6% coupon from the buyer now. So he didn't really care if the buyer defaulted because he could just foreclose and repossess the property, collect all the interest that he's already had, and just pay us off our first lien. So he liked it. But on that deal, yeah, it was at 6%. But I've seen typically it's like 6 to 10%.
Yeah,
Rate on that.
yeah, thank you. That's a great explanation too. And then I guess with that seller side of the deal, where do you guys stand as far as the negotiations? Where are the relationships and the conversations coming from? Are you talking to all parties involved, or is that more?
We have to. So what happens is, because it's an asset-based loan, there's no rent roll, there's no financials, there's no tax returns. We only collect a credit report to have it in the file. But I mean, even if the person had a 400 credit score, it wouldn't apply in this situation. Because we're only going up to 50%. And I want to point out there that this is for metropolitan areas only. If it's rural, we're only going to go up to like 30% loan to value. So we're looking for major markets, nothing with like out in the country. If it is, the LTV will be cut drastically. So I want to be clear on that. But what we have to do is we actually have to have a conversation with the broker or the attorney or the seller to verify that they're willing to be in second position, and also that they have a clear title to the property. Like, we won't even issue an LOI until we verify that they're going to carry the second and that the title is clear.
Okay, yeah, that's awesome. So really, it's pretty straightforward. Everyone accepts the risks and rewards there. And you mentioned way back how your kind of way to mitigate the risk is not to get rid of it, but rather just to get paid for it. So where do you start as far as determining those type of numbers? You say, you're getting a 13% coupon or whatever it is. How exactly are you getting to those numbers to kind of get out of the deal?
Because for example, like if our investors, so we're like, for that particular deal, that's a fund that we have, and in our covenants of our fund, that fund is requiring annualized, 20% return. So with the points that we charge and the interest rate yield, we have to be somewhere around there annually, right? So that particular loan fund, given the fact that they're doing a hard money loan that's asset based, they want to be around 20% yearly. And so that's what it commands, right?
Okay.
Like if we were doing, let's say, let me give you an example, another fund that we work with, if the person had a 700 credit score and it was full doc and they put 25% down, then the yield would be like 5.5%. That's the covenants of that fund that, okay, I want a 5.5% yield because this person is fully documented, it's low risk, right? Versus a hard money fund, you know, it's way different type of deal. It's extremely risky. And you have to ask yourself in the fire sale, if I had to unload this property, what am I going to get for it? Right. And that's the thing. Like for example, if we're doing like this, like the one in Jacksonville, if it's 3.5 million and we have a first mortgage for, let's just say 1.7. Okay, if I had to foreclose on this thing and sell it in a fire sale, could I sell it in 30 days for $2 million and get out of it? Well, chances are yes. But if I'm fully leveraged at 90 100%, then you're screwed. So but that's the reasoning behind it, Dave.
Okay, yeah, perfect answer. So I guess as far as you get this loan signed, originated, everybody's kind of on terms. Can we just kind of talk through the exit process and what you typically see as far as business plans and basically
Yeah, yeah,
what is your
that
favorite way to make
yes.
money on this deal? And maybe what's an investor and a seller's favorite way? Just
Yeah,
some
yeah,
scenarios here.
that's a very important thing. So typically, typically what the takeout is, a community bank or SBA, something that's going to offer high LTV. And so that has to definitely be thought through. How are you going to get out of this thing? And so a lot of time, like we did one today in Chicago, it was a apartment complex completely gutted. I mean, it was a condemned building. I mean, it was massive. I mean, it was going to fit over 200 units, but at its current state, the as-is value was $1 million, and it called for 3 million in repairs, and the ARV was 10 million. So the thing is, we did this exact same loan that I'm telling you. We put him on this loan, and which was really cool. And the fact that the investor had a 500 credit score, and usually lenders don't make rehab loans to investors with 500 credit scores. They normally want you to have at least a 620 credit score. So, and we allow the investor, our borrower, it's no personal guarantor. It's a non-recourse loan. So we had to work through the strategy on how he's going to get out of this because it's a 2-year bridge loan on a 40-year amortization. So um, the once we close on the loan and we manage the draw disbursements, which he gets to manage based on our oversight, um, and this property is completely stabilized, right? Then he's only going to have a loan to value with the ARV like at 47%. So at that time, once it's completely renovated, any bank, even in Chicago where this property is, would certainly take this property, especially if you had tenants in there, at 47% loan to value, completely stabilized with a rent roll. And in his case, we enrolled him into credit repair because he had to get a score up for a bank to even consider him, for the refi. So that's a perfect classic scenario. Hey, we're going to give you this bridge loan. We're going to go into credit repair. We're going to oversee your draws, make sure that the property is actually getting repaired and fixed. And then once it's done, then you're going to refinance. We're going to take you out with, BB&T or Regions. And of course, they're going to do it because you have a rent roll now. You have a very attractive property. And so that type of situation, I mean, you think about all the good that we're generating. We're giving people jobs. We're revitalizing and gentrifying the city because that was a condemned building. And so that's a classic scenario right there.
Yeah, and that's a great point you made. I mean, you can, of course, you protect yourself and you can make money if this goes south, right? You're still going to make your money. It might not be a happy day, but you're going to be able to sell a property and still make some dollars. But at the end of the day, you do want to be able to just have it go successful, have the business plan that the operator wants to do be successful, and everybody can
Right, absolutely.
be
Yeah,
out
this
of the
is not.
deal.
Yeah, that's right. That's right. This is not a strategy to take people's properties. This is we don't want to do that. We don't want to do that. It's more so being. Here's the thing. I mean, there's so many lenders out there. There's so many investors, and you try to figure out how to be different, be creative, be unique with capital. And so The other thing is I want to say that I want to add is that this loan has an interest reserve built into it. So we can impound anywhere from 3 months to a year of payments, which also protects the investor too, so they don't to prevent default. So like we did a $40 million home in Beverly Hills. And obviously that's a massive deal for a home, but this is just a single family residence for, a wealthy individual. And it had a year of interest payments, set aside because we don't want that builder to go into default either. So having a year of payment set aside makes it much more appealing to the investor.
Yeah, and it sounds like as long as those conversations are being had up front, it seems like everybody can get comfortable with the situation. Obviously, there's paperwork to back that up, but yeah, it seems like a great setup. So, say Angelo, I walked in today as an investor. How could I best prepare myself for that first talk to be able to get my deal across the table?
Well, I mean, I think that obviously we have to assess, what your goals are. What are you trying to do? Because I mean, there's so many different ways, to make money in real estate. Are you trying to do fix and flips? Are you trying to do long-term holding? Airbnb is very hot right now. We do a lot of Airbnb funding. So we really need to find out, what, obviously what your liquidity is, who are your contacts, what are your partners, what's the market you're trying to focus on. And then because we also, one of the things that's really cool, Dave, we also, through the bank, we have something called an investor line of credit, and we can give investors lines of credit, for building new construction, for doing fix and flips, for doing apartment complex, ground up construction, and mixed use property, all on the same credit line. And we can go up to $100 million credit line, for an investor. And I help a ton of investors because that's something that's really cool because a lot of banks don't like to give lines of credit, for all of that on one line and to be able to do fix and flip too. So that's a really hot product for your followers that they find very attractive, and it's very easy to get approved. You just have to have a 620 credit score for that, and just 50,000 of liquidity to qualify. Our minimum credit line is 500,000, but that's a great program. We also, another good program that your followers may like, for seasoned investors, we offer 100% loan to cost, 70% ARV for fix and flip deals up to $1 million, 1 to 4 family. So basically, if you find a property, let's say you find a foreclosure for 500,000, and the ARV is 900, and you need 100,000 for rehab, we'll fund that entire deal, the acquisition and the rehab, and give you 100% loan to cost. That means you put no money down, right? And as long as you have that 30% equity spread and you're a seasoned investor, this isn't your first time, you can buy that deal with no money down and get 100% financing, and the interest rate's only 10%. And you could flip that property and make 200 or 300 grand if you do it right.
Yeah, that's pretty powerful. On a small deal, you could turn that around pretty quickly and make a good chunk of change, like you said,
Yeah,
for no
yeah.
money out of
You think
pocket.
about, yeah, a lot of lenders require at least 10% down on a fix and flip. If with us, we'll go at 100% loan to cost if we have 30% equity there.
And then back to that line of credit, just from my experience, that's mostly because of bank relationships, and typically it's because it's local bank relationships. So I guess, how are you able to provide that? Where did that kind of stem from? I'm just curious.
Well, because we do, so you don't have to be local with us. We offer that from nationwide, from Hawaii to New York. One of our funds that we work with, it's actually connected to Blackstone. And they have, that's more money than God, so they actually, through many conversations, came up with this program. And so the idea is that, they have a lot of money. There's a lot of investors out there, and to come up with a very diversified product, that would allow the investor to be nimble. Let's say you're dealing with a very savvy real estate investor that knows how to do new construction, or he wants to do mixed use, C stores, or he wants to do fix and flips. He could put all that in the same credit line and get very, very good terms. The interest rate on that program starts at 6.9% interest only. The idea is just to help that guy that is, it's a wealthy individual. That's how he makes his money to scale his business. Because the issue that, like, think about, if you're doing all these deals and every time that you go to take down a new deal, You have to apply for a new loan, have your credit ran, resubmit the application. When you have a line of credit, it's one and done. If I get you approved for a $10 million credit line, you don't have to apply anymore. All we need is a appraisal or a broker price opinion of the collateral and a title commitment, and we can close the deal in 1 to 2 weeks. That's the power of getting a line of credit approved. And maybe you want to do multiple things. Maybe you want to invest in a new construction and community and development, or maybe you want to do a string of fix and flips. That's the idea behind it.
Yeah, definitely. I mean, if your source of capital is what's holding you back from stabilizing a property or even securing one, yeah, definitely good to have options like that. So a lot of
Absolutely.
a lot of good stuff so far, Angelo. Are you ready for the 5 key questions?
Sure.
All right. So first one, what is a disadvantage that you had while starting out?
The biggest disadvantage I had is I didn't have proper training on how to recruit and hire and retain a team. That's been one of the biggest, toughest, hardest things that I've had is scaling the company and hiring the right people.
Awesome. And then a little bit easier, what's an advantage that you had while starting out that's helped you kind of succeed and level up?
Yeah, so that's a great question. I grew up very poor, rock bottom. So I think that because I meet a lot of people now, and I've interviewed and I've probably hired over 200 people. And I see that that one of the things that helped me to build the company, I worked, 16, 17 hours a day, for the last 10 years, every day, no days off. And I think one of the advantages that I always had my back against the wall, because I grew up with nothing, and I had always this hunger, this passion to push me beyond my feelings of pain or being tired to do whatever it takes to get the job done, whether that meant not going out on the weekend or not going on vacation or not going to play, just to make sure that I got my job done. And when I meet with other people and they refuse to take a phone call or respond to a text or an email because it's after 5, or they don't want to work on the weekend to get a deal done, and then they complain why they're broke, I think that makes me feel like, hey, this is the reason why I was able to build this company, is because I put the blood, sweat, and tears into this thing to make it work, right? So if I could say that, somebody that's had a rock bottom life or something's happened to them, a catastrophe, and they can use that to fuel it for a fire, then they need to do that, because it will really transform their life.
Yeah, that's awesome. It's always better to earn your success than to win it. So yeah, I love that for sure. Mm-hmm. And then what is one thing you've learned that books, podcasts, or other media did not teach you?
What is one thing that I've learned that books or podcasts or other media has not taught me? Is that the question?
Yes. Yeah.
See, so I want to make sure I understand what you're asking me. So, give me an example about what you mean.
So I guess typically, this is a great show, of course, but for example, everything we talked about previously today, no one else can really attain it as well as they could have if they employed your strategies themselves, for example. So if they were to take your strategies from this previous half-hour talk and they did them in their real life, they would still find something that we did not talk about today, and some nuance that, is a little more complicated than it sounds on the show, or just anything that I guess when you're shaking hands and taking down deals that you've seen that you weren't prepared for, that you never would have been until you did a deal, basically.
Yeah, well, I agree that. So I think that what you're saying, I'm just trying to make sure I understand what you're asking me. Yeah, I think that when you actually go through something, you experience something, on your own, you go through it. Like a podcast, like what you do is phenomenal. I think that how I do most of my learning is video learning or audio. And so it's great, but it's not a substitute for real life. And so I think that you have to go through these things, or have a coach or a mentor beside you that can guide you and walk you through the process. Because you and I are talking for 5 or 10 minutes or 15 minutes, but we're talking about, constructing multi-million-dollar deals. There's 1,000 details.
Right.
And so it's not just sign a piece of paper and get an appraisal and fund a loan. There's a lot of things that we didn't talk about, and you're not going to really be able to understand that completely in your mind until you go through it, and you see all of the ins and outs, all the conversations, all the negotiations, all the emails, all the text messages, all the conference calls. Books, podcasts, they put a reference or a blueprint, but ultimately, on the job or real life experience, is going to take, precedence, because that's when all the emotions and all of the, further collaboration and communication takes place. So, I'm a big advocate of books and podcasts and YouTube and all of these things, but in the end, yeah, I mean, you're going to have to experience these things. Yeah.
Definitely. And then I guess what is one thing now that you've been working on to improve yourself or your business?
Yeah, I mean, so I'm real big about always trying to be very self-aware of my actions, watching my team, and so personally, not getting, not getting addicted to anything. I grew up with a very addictive personality, so I watch myself very carefully. With my diet, I exercise. I do about 10 to 15 miles of cardio a day, making sure I get enough sleep, controlling my focus, my mental focus, the things I think about. So self-improvement's a big part of my life, personally. With my team, just making sure that everyone that I come into contact with, one of our mission statement, our core value is that by working with Angelo Christian, did your life get better? And how can we measure that? Right? Because like you meeting me today, I don't know what the future holds between you and I. Maybe one day we meet, maybe we do a deal together. We've crossed paths. The universe has connected us. And did your life get better by you talking to me today? Or my team did. So my team, when I hire somebody, there's usually a huge transformation financially, mentally, spiritually. And so that's a very important thing for my team and my family, to help everyone that I come into contact with to go to the highest level possible. Because I believe, just like the iPhone, we all can go to the next version, right? And so we have to keep pushing ourselves. The next year is the higher version, and to keep striving to that higher apex, right? So that's a very important thing for me.
Yeah, and that's fun in my experience too. I mean, my team is kind of all elevating and one upping each other here, and so whether it's personal or business related, it seems to be the case where everyone kind of brings each other up. A rising tide floats all ships. So it's fun to see that. It's a lot of fun.
Yep. It is. It is. I've helped people on my team buy new homes, new cars, make families. My son, who wants to be a professional baseball player, help him get him the things that he needs. So I think it's all about like Maslow's hierarchy. You have to create stabilization for yourself, and then after that, you have to give back and contribute to others.
Awesome. And then last one here, Angelo. How can a listener reach you today if they want to get a hold of you?
Yeah, no, I'd love to talk to you guys. If you guys are investors out there, you need real estate funding, we'd like to help you guys any way you can. You can call our office at 832-431-6331. We're actually open every single day. Okay, so we don't take any days off. So someone's always here to take your call. Or you can visit our website at officialangelochristian.com, or you can check me out. You have a pretty good YouTube presence. You can go to my YouTube channel at Angelo Christian, or Instagram is official Angelo Christian. So any of those methods, we'd love to help any investors out there, people that need help with funding, to reach out to our office.
Really appreciate it, Angelo. It was
Absolutely
very fun listening to the way you take on servicing loans. Very interesting kind of way to do it.
Thank you.
Very
Thank you.
Dynamic. I like it a lot. A lot of ways to
Awesome.
get a deal done, and a lot of just good value overall. So I really appreciate
Very
it.
good.
Thanks for coming.
It's my pleasure, Dave. I look forward to working with you in the future.
Have a great day.
All right. Thank you.